Imagine you keep on investing in a company for the past 5 years, and today when you wake up, you still see your portfolio in 50% loss? That's what's happening to Alibaba. To add salt to the wound, the company had negative earnings in the most recent quarter. The losses make investors question, has Alibaba lost its edge? Is it time to sell Alibaba before it gets even lower? Well, let's find out. In recent years, investors are increasingly disappointed by Alibaba's performance. The company's earning has been decreasing significantly since 2021. In the most recent quarter, Alibaba even suffered a 22 billion losses in RMB. What? But before you decide to jump ship and sell away your stocks, because upon close inspection, Alibaba is still a profitable company. Its total revenue still grew 3% year on year, reaching about 207 billion RMB. Most aspects of business have enjoyed consistent growth, with the exception of China commerce, which experienced a 1% drop in revenue year on year. But with the China's border reopening, the situation is set to improve. Now let's take a look at its losses. Alibaba attributed the shift from profit to losses to an increasing in net losses resulting from the decline in market prices of equity investment in publicly traded companies and the reduction in share of results of equity method investees. The substantial drop in valuation was mainly linked to its controversial financial unit and financial. So if you disregard the investment loss and look at the non-GAAP reporting, the company will have achieved a 19% year-on-year growth in terms of profit, totaling 33.8 billion in RMB. Apart from its profitable e-commerce business, Alibaba has another growth engine: cloud. China has made significant progress in transitioning to cloud computing and now possesses the world's second largest market share. It's projected that China's public cloud will grow at a staggering pace, more than doubling from $32 billion in 2021 to more than $19 billion by 2025. Currently, Alibaba holds a market share of 36% in public cloud in China, with 8% of its revenue generating from cloud. While Ali Cloud is operating at its break-even point right now, as it continues to scale, it can start bringing substantial profits to the company, very much like AWS to Amazon. So as the cloud industry continues to grow in China, it has the potential to boost Alibaba's both top and bottom line. But I know you must be thinking, Alibaba has so many competitors, what if it got overtaken by others? Well, indeed, that's a valid concern. But we also cannot deny that Alibaba's competitive advantage is enormous. Despite competition, Alibaba has achieved 90% retention for its core annual active consumers. Additionally, Baba owns 1/3 of Alipay, which is responsible for 54% of all payment in China. So competitors like JD in e-commerce, Huawei in cloud computing, and Tencent in payment are all trying to catch up with Alibaba. Do note that none of them operates in all three areas, while Baba is the leader in each category. So in the Chinese tech sector, Alibaba is in a class of its own. So is Alibaba a good time to buy right now? Let's take a look at the company's valuation. Due to the recent drop in net income, Alibaba's PE ratio has been pushed to 48 times, which seems really high. However, just like we mentioned earlier, the current earning is not the true representation of the company's earning ability. It is therefore not accurate to look at the PE ratio right now. Instead, we can look at other ratios like PB ratio, price to forward earnings ratio, and based on these two metrics, they are both below the 5-year average, which means that Alibaba could be presenting a good entry point right now. Another way to put Alibaba's valuation into perspective will be looking at its stock price. In 2014, Alibaba IPO at about $90 a share, and after 10 years of growth, the stock price dropped below its IPO share price, trading at only $87 per share right now. It literally means that you can buy Baba right now cheaper than its IPO price, except with 15 times revenue, 4.5 times of free cash flow, and 3.5 times of its operating income. In all aspects, Baba looks like a steal to me. But in case you think that $87 is still too high, well, you can consider using options to buy it even cheaper than the current market price. You can use BOSS option strategy to promise to buy at $85, and in return of you making this promise, you get to collect about $224 in passive income. That's a 2.6% in 15 days. On the other hand, if you already own a large amount of Alibaba shares and you do not want to sell away at such a beaten down price right now because you still believe in the company's future, you may consider using option strategy Y to protect your portfolio from its further downside. So if Baba does drop further from here, your options insurance will kick in, giving you an extra profit boost. There are different option strategies that you can use to suit your investment objective, but most importantly is to get yourself educated first. If you want to learn how to use options to profit and even protect your portfolio in this volatile market, you can join us in our upcoming free 2-hour next level options masterclass. Just click on the link around this video and register for your free spot. So what's your take on Baba? Is it a buy or a sell? Comment down below and let me know your thoughts.